If you work with the CPA that only wants to do your tax returns once a year, that's a wrong relationship. You'll fail.
Law firm owners leave hundreds of thousands in tax savings on the table yearly. Emil Abedian, CPA and founder of Council CPAs, saved attorney clients over $400,000 through strategic planning most accountants never discuss. Specializing in legal accounting for lawyers, Emil spent 17 years transforming struggling practices into profitable businesses using cost segregation studies, short-term rental deductions, and pass-through entity elections. You'll learn specific tax frameworks that immediately reduce liability, including the PRO system, bonus depreciation under new legislation, and structuring to maximize deductions. If you're overpaying taxes while competitors legally slash bills, this shows exactly how to keep more of what you earn.
Emil, welcome to the podcast.
Good morning. Thank you so much, Scherrie, for having me.
Look, thank you for being here. I'm excited to talk about something that is near and dear to my heart, and that's law practice.
So likewise, it'll be a nice conversation.
So we've already given just a background on who you are and what you do, but if you can just tell us how you specifically got into helping law firms be better.
Yeah, absolutely. I started my practice. I'm a CPA now, only working with lawyers and law firms, but that's not always been the case. Obviously, when I first started, you just take on whatever that comes your way. Whoever calls you, whoever wants some help, you're there. You want to just do some business. But pretty quickly, you realize that's not going to work in the long term, getting busy. Same with law firms, with the same kind of operation that lawyers are running, but offering different kind of service. So you keep on getting busier. And one day I woke up, said, I can't do this anymore. If I keep on running my practice, offering my services to everybody who just knocks on the door, it's just not going to work. So I started gearing my services more towards lawyers, as law firms have a little bit specific needs than any other business out there. Number one, with each state bar regulations for the trust account they're handling, but also lawyers in general. Actually, you go to law school, you learn the trade really well. Many lawyers are excellent lawyers, but they don't really learn how to run an operation, how to run a business. So that's where I really wanted to come in and fill the gap between the business owner and the lawyer, to be able to help them build a business rather than running just a practice.
And that is so true. I do not recall a single course that actually focused on the business aspect when I was in law school. Now, that was many scores ago. I'm not going to tell you how old I am, but that was a while back. But still, they do a great job with teaching you all the fundamentals of the law. But for someone who is looking to hang their own shingle, they may not be going to a big firm. This is when basic accounting principles and making sure that you build that moat around your business is very important. So for someone who's for the first time, they may not have been a business owner, but they're a new attorney who's looking to hang a shingle. What are some of the things that they should be aware of when trying to engage an accountant or a CPA like yourself?
Yeah, absolutely. So number one, I get that question all the time because we work with a lot of solo practitioners that are just starting up. And this question for them asking me is, why you? Why should I hire you? Why are you so special? I'm not special, first of all. I'm not a rocket scientist.
You are special.
We're special in our own ways, definitely. I'm saying we're not rocket scientists. I'm not going to the moon. But what's different from a good CPA and just an average CPA is a CPA that cares. A CPA that works with you throughout the year. Because as a business owner, as a lawyer or any other business owner, you're so focused in growing your business that you don't have time to really focus on the other stuff that the CPA is doing for you. One of the things, there are other things that you should probably look into outsourcing also. But so I tell them, if you work with the CPA that only wants to do your tax returns once a year, that's a wrong relationship. You'll fail. I can guarantee you that. I've done that for my client, and it created so much issues between me and my clients back in the days when I was just preparing a return. They were giving me their shoebox, let's say, or financial statements and asking me to prepare a return. I'm no different than H&R Block or any other tax preparer if I do that. and we're just doing a disfavor for the client. And let me just add on here, many times the client, the lawyers in this case, do not know what a CPA can offer them. They typically have this picture of a CPA preparing a tax return, maybe helping out with payroll reports and doing some bookkeeping, and they think that's all a CPA is doing. But that's where I think they're going wrong. They want a strategic partner that works with them throughout the year and is on their side at any given time. So that's what I would say. If you're looking for a CPA, make sure the CPA is working with you throughout the year and not sees you just for tax return preparation.
Yeah, and that's such an important distinction. That's the distinction between tax preparation and tax planning, because that strategic partner is the person you call and say, hey, I'm considering buying a business or selling my home. What sort of, tax implications do I have? And so let's dive a little bit deeper into that, because when we talk about tax planning, part of that, and this is me putting my legal hat on, part of that, one, is making sure you start out with the right type of structure. Do you have an LLC? Do you have a corporation? Because the tax basis for those is different.
100%. And I created a little fun acronym for that, what you just mentioned here regarding tax planning, and I call it PRO. Lawyers are professionals. We're not amateurs. I'm not a lawyer myself, but lawyers are not amateurs. They're professionals. So I created this 3-letter acronym, PRO, starting with planning. P stands for planning. If you don't do planning, you can know all the tax code in the world. You will not be able to implement most of them, because planning, tax planning, comes from the word planning. You really have to plan to be able to implement it. And the R in it is roadmap. So when you plan, we create a roadmap for ourselves. With the roadmap, with the O, we create opportunities. So we want to keep that as a lawyer. There's no science behind it, by the way. It's just something I created, but I think it works really well with tax planning. We are pro, and we want to plan to create a roadmap for ourselves to take advantage of all the tax code out there, the opportunities out there. So if you only see your CPA once a year, most of the tax planning strategies will not be able to be implemented. But if you work with them throughout the year, you have regular scheduled meetings with your CPA. When you're buying that property, you just pick up the phone or email or Zoom or however you want to connect with your CPA to discuss those details. Because just as an property, as you mentioned, there's so much that could be done through tax planning when you buy a property. If you don't do the planning, you might lose out the entire benefit of the property deduction. Definitely, you need proper planning throughout the year to be able to implement all of these. And we can dig into a little bit more details in what the opportunities are, what for specifically lawyers. There are a lot of things lawyers can do to minimize their tax liability in a legal way. We don't do anything that we want to lose sleep over, obviously, but you don't have to lose sleep over it, because there's so much opportunities out there that could be taken advantage of.
Yeah, and it took me a while to realize that the tax code is actually my friend, because the tax code tells you, it incentivizes you to do things that will not only benefit you, but benefit others as well. So if there are credits for doing solar panels or things like that, these are things that you can take advantage of, but it takes planning. So let's talk about some of the different things that entrepreneurs can do in terms of planning that will help them. I know one that's very popular among some entrepreneurs is like the Augusta Rule, where you may be able to, and I'll let you explain. I'm not the expert. I know enough to be dangerous.
I will explain that. Before we do that, you mentioned the solar panel credit. Just keep in mind, with this new One Big Beautiful Bill Act, solar panel credit is going away as of end of the year. So if you're gonna renovate, you're gonna change your panels and put new panels on, you want to do it this year in 2025, because that's a big credit, a 30% credit on the purchase price. And just another little tip there, it's not enough for you to have a contract. You actually have to have completed the project and installed the panels for the credit to be applied for this year. Just keep in mind, everybody who listens. That's right. Augusta Rule. It's a fantastic, actually, tax deduction that you can take advantage of. Comes from there's a golf tournament. I'm not a golfer myself, but back in Georgia, it started in Georgia, where the population or the homeowners started renting out their homes to all of these people who came to this golf tournament to watch it and the audience. And Georgia got this Augusta Rule tax benefit to be able to rent out their homes, their primary homes, for up to 14 days a year, tax-free. So just as an example, you rent it out for $1,000 a night. That's 14,000 up to 14 days. That's $14,000 that you have tax-free income as a homeowner. So that's the Augusta Rule, which is a great deal. I'm in LA, so with Hollywood being around the corner here, there's a lot of Hollywood like movies shot on people's homes, and they pay a lot of money per day, up to 10,000, maybe even more. So that could add up to hundreds of thousands of dollars in tax-free income for people who rent out their homes for up to 14 days.
Now, I just want to do a caveat because at the time that we're filming this, I'm in Flowood, Mississippi. The rental price has to be market, correct? You can't have a
Absolutely.
500 square foot home in Mississippi that you're renting out for $100,000 a day.
That's correct.
Okay, because you're going to really need Emil then for your audit if you do that.
That's very true. On the other hand, if there is a totally unrelated person renting that house, let's say a Hollywood studio is renting your house, that's the market value. You don't want to rent it out for 100,000 to your own company or to your cousin or to your uncle. No, you're right. That you want to be careful. But if there's totally unrelated company paying you, they wouldn't pay you 100,000 a day, obviously, Hollywood, but they pay up to $10,000-$15,000 a night for shooting this movie. So that could add up pretty quickly.
And just very practically, for someone, what are some of the limitations? Does this work if you have a limited liability company, a limited partnership?
It has to be your primary resident. And I never seen a primary resident put into an LLC. It shouldn't be put in an LLC. If it's your primary resident, it should be protected. I'm not a lawyer, but it should probably be protected through a trust rather than an LLC. So the limitation is primary resident that you live in typically, but you just move out temporarily to rent it out, and 14 days or less of rental income coming. Those are the main limitations.
Yeah, and I think it's something that with planning, a lot of entrepreneurs do not think about. Now, can it be 14 consecutive days or do they have to be spaced out over the course of the year?
No, it just says 14 days or less a year. Could be consecutive years, could be spread up over the year. It doesn't matter.
One thing
It's like you like real estate. I have a lot of the real estate tips for you, Scherrie. So remind me to come back to it.
Well, look, and I'm going to tell you something that people that know me personally know this. I'm actually a real estate broker. I was in real estate before I became an attorney. And after the big mortgage debacle, 08, 09, is when I went to law school. So that's my first love is real estate.
Okay. Then I'm going to share some really good tips with you today. So to take it with you. One thing, let's talk about it real quick before I forget it. The short-term rental tax planning strategy for the listeners who have rental properties that they rented out short-term. That said, like Airbnb kind of a style rental. Doesn't have to be through Airbnb, but Airbnb style, where you rent out, your average stay per tenant is less than 7 days, 7 days or less. So you have one tenant that stays as 14 days, another stays as 2 days, another stays 5 days, but the average is 7 days or less. That converts your property to a active participation. So basically what happens is that typically, if you're not a real estate professional, which means that you don't spend more than 750 hours within real estate or more than 50% of your total activity. Let's say, Scherrie, you're a lawyer, but you're also a real estate investor or a broker. You spend, let's say, 1,000 hours a year within real estate. So you meet the criteria for 750 hours for the real estate professional criteria, but you also need to spend more than 50% of your total activity within real estate. So if you do more than 1,000 hours within your law firm, you would not qualify as a real estate professional. So all your real estate would be passive and you would not be able to deduct those losses against your law firm income or any other ordinary income that you have. The short-term rental is a loophole for that. As long as the average stay per tenant is less than 7 days or less, again, and you don't have a management company you run this for you, You can have Airbnb as a base for renting it out, but you manage this property. Those losses are now active, and you don't have to have the 750 hours participation and the more than 50% of your total activity that we just discussed for real estate activity. You can still take your losses, which can create a significant deduction against your law firm income, especially if you combine that real estate with a cost segregation study. I'm throwing a lot of planning tips here, which is good.
Take notes, everyone who's listening.
Yeah, this cost segregation study, guys, it's amazing. It basically allows you to accelerate the depreciation on the property for the first few years you buy it and place in service. And now with bonus depreciation going back to 100% with the one big beautiful bill, basically your benefit from a cost segregation is even more than it was the last few years. What it does now, just a quick rundown of what it is, you buy a property, let's say it's a residential property that you rent out. Typically, the building value of the property, depending on where you are in the country, the building and the land value fluctuates. In LA, the land value is significantly high, so probably it's 50% or more of the property is land value. But I have clients in North Carolina, for example, where the land value is 10% and the building is 90%. The reason it's so important to determine the land and building is because land is not depreciable asset. The IRS does not see the land as losing its value. But the property, you use it and it depreciates its value. So you can depreciate it based on 27 and a half year calculation if it's a residential. So commercial property is 39 years. But 27 and a half years is a pretty long time. We want to deduct that more aggressively. That's why we do a cost segregation study. And there's an engineering company that comes out and breaks down the property in different components and breaks it down in 5, 15, and 27 and a half year properties. The 5 and 15-year property, which ends up being anywhere from 20 to 30% of the total land building value, typically, could be a little bit more, could be a little bit less, but I'm just giving you some ideas here. That could be taken a bonus depreciation on and deduct all of it the year you buy it and place in service. Let me give you an example if that will help you. You buy a property for, say, $1 million. We're in North Carolina, 90% of that is building, 10% is land. So we have $900,000 worth of building. Let's say this cost segregation company comes out and does this study for you and tells us that 25%, let's be conservative, 25% of the building is subject to 5 and 15-year depreciation, which is that's the only part we can take a bonus depreciation on. Anything above that, we have to do regular depreciation. So 900,000 times 25%, the 900 times 25, that's $225,000 that we can depreciate the year we buy the property. That $225,000 will offset your income from your law firm the year you buy the property. Boom, a huge deduction.
That right there moves you so high on my Christmas list. That is so good. And one thing to think about, and this is why it's so important to have a CPA like you who does tax planning, is because if you were someone who, like for me, I'm an attorney, but I'm also a real estate broker and I have other businesses. A conversation like this, because your income streams may be different at different times of the year, there are different activities that are going on. And if you have one particular stream of income that is a lot greater than the other, this is a great way to look at offsetting some of that income. That is so good.
It's amazing. I have another one. Can I share one more?
No, look, several. We have time.
Good. Within real estate again. So we talked about the short-term rental. The other one is self-rental. So let's say you have a law firm and you decide to buy your own building to occupy it for your law firm, which we have a lot of clients here that does that. They buy their own building, commercial buildings. And typically, again, as a lawyer, you do not qualify a real estate professional, so you lose on the deduction. You don't lose on it. You have to just carry it over until you sell the property, which you just delay taking the deduction. That's why we want to take as much as possible now. But with the self-rental, you buy the property with an LLC, you put the commercial property LLC, and your law firm, S-Corp or LLC or LLP, whatever entity you have, is renting from your own LLC, building LLC. We can combine them. We can make an election with the IRS to combine those those activities. Legally, you're still different entities, so we don't want to combine them legally. But tax-wise, we make an election to combine them to be able to take the losses from the real estate and offset your legal law firm income. That's the self-rental. It's called self-rental deduction, that you're exemption towards the real estate professional rules that you have. So that's a great one that a lot of our clients are taking advantage of also.
That is so good. And pivoting just a bit. So, what about being an accredited investor and the advantages of that and some of the things that you do that you need to do to plan for that if you are an attorney and you have other ventures as well?
With an accredited investor, it's really not anything tax related. It's more legal related, in my opinion. That it's not changing anything for your tax from your tax perspective. So the IRS is not giving any advantage or disadvantage to an accredited investor. So there's really nothing specifically there that affects your tax situation. It's more of what kind of activity, how do we classify this activity? Is it active or is it passive? And since your law firm income is most of the time, active, we want all your losses to be active also to offset your law firm income. We don't want to lock in passive losses for the future year because God knows what's going to happen 10, 15, 20 years from now. We want the benefit now to be able to reinvest the money and grow our wealth.
And what about family businesses? Sometimes we may want our kids to work with us in our business, or we may want a family office. What are some of the things from a tax perspective that we need to consider?
That's great. That's a great question. So, by the way, most of these questions, I have videos on our social media about this. So I love the question you asked because I already talked about all of these topics. If you have kids and they're in the age that they can work, obviously, you don't want to put a 2-year-old in your law firm pretending that the 2-year is working for you, unless you really use them for marketing material and pictures and all of that. But most of the time, lawyers don't. But you can put them on payroll through your company, and up to $12,000, like $12,000 to $13,000 right now per kid, that you can pay them and deduct that from your own law firm, and the kid will not pay tax on it, which you're basically double dipping here. The parents are deducting it. Mom or dad, lawyer, law firm owner, is deducting the payroll paid to the kid. The kid does not have to declare it because it's less than the standard deduction. And if you want to make even more benefit, you can even pay them a little bit more. Let's say you pay them $25,000, but they only pay tax on the difference between 25 and 12,000 or 13,000 with maybe 10% bracket, whereas the parent might be in the 50% bracket. So it's a significant tax saving by planning it and putting your kids that are in a reasonable age. Keep in mind, don't put a 2-year-old and pay them $20,000 a year for drafting legal documents, for example. You cannot do that.
And when you say a reasonable age, I know in terms of the floor and the age, but is there a certain age that you would not consider them for this? Do they age out at 21 or 18 based on the state?
Yeah, I don't think aged out, depending on where they are, and they might be going to college at 25, you can still pay them. They're not making any money. It's the upper limit is when are they making their own money. So if they start making their own money and working, then you want to stop paying them from your own law firm because that's not going to benefit them anymore because they have other taxable income. But at the lower end of the range here, when you should start putting them on payroll, like I don't recommend anyone under 10 to put on payroll. My oldest son is turning 13 now, for example, and he actually comes in here. He does shredding, he does mail, he helps around here, and we give him a small payroll for that. I'm not paying him $2,000 a month, absolutely not. But anyway, from that, I don't know, $300 to $500 a month or so. Sometimes a little bit more, sometimes a little bit less. Summers he does more work. That I think is very reasonable. But my youngest son is turning 9. He's not on payroll yet. So just to give you an idea, got to make sense for you. You got to be able to justify it. Why this kid is getting $500 a month or not less or more or less. But the older they get, the more you can justify it. The more they can work for you and the higher you can pay.
And that's so interesting. My youngest is 18 now, and he started with my firm shredding and doing some running for me, and he hated the shredding. I do not look for him to become an attorney or anything like that. He was like, no, Mom.
Ain't gonna happen. Right?
It's not going to happen, Mom. It's not going to happen. Yeah, that is so good. What are some of the other opportunities that attorneys really do not consider before they start working with the CPA that you see with some of your clients?
Before they start working with a CPA, the unfortunate truth is that sometimes they work with a CPA, but they still do not take advantage of some of these things that we're talking about today. And it's not because the CPA is not aware of this most of the time. Sometimes, unfortunately, they don't know these kind of things, but most of the CPA knows this. The biggest problem, again, I think I touched on it earlier here, is that they don't have that relationship with their client to be able to identify these kind of opportunities for the client. We go back to our approach. It's to identify, to create that roadmap. And they don't work with their clients throughout the year, so they're not being able to implement that. One thing being that it's a very new thing for us, not a new thing, not a new tax code, but just recently happened. A relatively large law firm joined us, new client, two partners making about $3 million profit combined. So they have a good operation going on. And this client did not take advantage of the PT tax deduction, pass-through entity tax deduction. In my world, that's one of the first things we do because it's a significant tax savings for not only for law firms, but any flow-through entity, S corporations, LLCs, partnership can take advantage of it. Sole proprietorships cannot. So if you're a sole proprietor, you cannot do this. But this is basically a tax deduction for your personal state taxes that you anyways have to pay from your personal pocket. State taxes on your personal return. Most of the state, I think, I don't know, probably like over 45 states have implemented this, allows you to pay your state income taxes through your business entity, flow-through entity, S-Corp, LLC, partnerships, and get a deduction on it on your federal return, which is a massive deduction. In California, each state has its own kind of calculation, but California, for example, allows you to pay 9.3% of your business income, of your state taxes through your business. Let's make an example. This client, and this tax code started 2021. And unfortunately, if you didn't do the right planning, if you didn't pay estimated taxes correctly, you will not qualify. You cannot go back and amend prior year's return to take advantage of it. Unfortunately, I wish we could. But 21, 22, 23, 24, this client just came to us, so we'll do the 25 return and we'll implement it for them. So 4 years of $3 million income, that's $12 million of income. 9.3% of that could have been paid through the business to get a deduction. They still paid it from their personal pocket. That's $1.1 million in deduction that they lost over 4 years. This is only federal deduction. You paid from your state taxes, but it's a federal deduction. So 37% bracket, with this kind of income, you fall into 37% bracket. That is $413,000 in tax, overpaid tax that they pay just by not making this election.
Ooh,
You tell me if that's a good savings or not.
I said ooh, but I meant ouch.
Ouch. Yeah.
Ouch.
This client was not happy when they came to us. That's why it was so easy for them to come to us, because I only had to tell them about this. It's very easy for me to see. I look at the return, I can see if this has been implemented or not. And I just told them this. No, listen, 4 years, you've been missing out $413,000. You overpaid $413,000 over 4 years just by this. And there's other stuff in there that was horrible also. And again, I don't think the CPA firm they came from did not know about this. I just think that they did not have that relationship with the client to be able to implement it, to be able to see and project, because you need to make very small estimated payments to be able to qualify for it. If you don't, you lose it. So that's another huge opportunity for firms specifically.
Pivoting to attorneys who may have a virtual presence, because after COVID, a lot of people just switched to working online, working remotely, having virtual offices. So if you have, or even someone who has a physical office, but may also have a home office, what sort of opportunities are available? do you have the administrative office or home office deduction if you have a brick and mortar building as well?
Yeah, I don't like that. I typically don't allow my clients to take home office if they have a physical business location, because the law says that you have to exclusively and regularly use your home office for business purpose. You might be regularly using it every night. I have a small home office at home. I'm not taking the deduction, by the way, because I have a physical location. I have my team are coming there. I'm regularly using my home office because every night, most of the nights, I'm doing emails and working from home when the kids go to bed. But I'm not exclusively using it for business, which means, first of all, well, maybe that space itself is exclusively used for business. I don't use it for anything else, but I also use most of the days, my physical office where I'm right now, for my business location, and the IRS would not allow that. So if you have a brick and mortar, no. But if you don't have an office, definitely, as long as it's exclusively. If you don't have a regular office and you work from home, means your regular use is already qualified. You're regularly working from that location at home mostly, but you got to make sure that it's exclusively also from there, that you don't use any other office.
And you mentioned the big, beautiful bill. There are so many gifts in the big, beautiful bill. And the general person has not read every page of that, but I'm sure as a CPA, you're very familiar with it. What are some of the changes that really affect entrepreneurs and attorneys that they may not be aware of?
Yeah. I haven't read all of it either, so I would lie if I would tell you. Like 870 plus pages. I've read the portions that apply to my clients and lawyers. Actually, I just recently, last week, had a presentation to the Los Angeles Bar Association about that. And there's a lot of good things. Not all of it is great, but a lot of good things with proper planning. And one thing is, for example, you got to be careful with is the solar panel credits, like the home efficient improvements, which is the solar panel, is going away as of end of the year. If you're going to use it, if you're going to do it now, got to be installed and ready to be used by end of the year. It's not okay to have a contract or pay a deposit. Also, the electric vehicle credit is going away, which could be up to $7,500. That's going away at the end of September. So if you got to buy an electric vehicle, I'm glad we're having this call recording now. I hope it's going to get published before end of the month. But if you're thinking of an electric vehicle, buy it now. For electric vehicle, it's enough to have a contract and a small deposit. You don't actually have to have taken the car in your possession. September 30th for that. And we talked about bonus depreciation with the real estate, but that applies to any kind of, most of the assets actually. So you can buy assets for your business and depreciate the entire amount the year you buy it. And that's been extended permanently, which was, by the way, before the One Big Beautiful Bill going away. So the bonus depreciation for this year was only 40%. 2026, it would be 20%. And then as of 27 and on, it will just disappear. But the 100% bonus depreciation has been extended permanently, which is great, which means you buy for a law firm, you buy you buy a server for your law firm. Nowadays, people probably don't buy servers anymore. It's all cloud, but you pay $10,000 for a server for your law firm. That typically you would have to depreciate that over probably 5 years. So take $2,000 every year. But with the bonus depreciation, you can take entire $10,000 at the time you buy it. Same thing if you buy a car for your business. You want to make sure you buy the right car, because if it's a 6,000 pounds or more, that would qualify for a bonus depreciation as long as you use that car more than 50% for your operation. Now, you got to be able to justify that the car is used more than 50% for your operation. But if it does, the bonus depreciation will apply for cars. For some reason, LA, the G-wagons, these Mercedes boxy cars are very popular here. Feels like every other lawyer is driving a G-wagon here. And it might be because of the bonus depreciation. That's because it's more than 6,000 pounds that you can deduct that against the year you purchase it. Other thing, the SALT deduction, state and local tax deduction. If you remember when Trump took office first time around, 2017, think it was 17. He put a cap on state and local tax deductions. State and local tax deductions means all your state taxes you're paying, depending on what state you are in, including your property taxes. That's a state and local taxes. Before Trump took office first time, that was unlimited. You can deduct as much as you had in state and local taxes. Trump put a cap on that for $10,000. Now, the high income states such as California, New York, we suffered a lot because state taxes are high. And typically in these kind of states, the property taxes are high also. So a business owner making, let's say, $1 million, that's probably $100,000 or $80,000 maybe state taxes only. So you can not only deduct $10,000 of that. So that was a big hit for the high income tax states, such as California and New York. Now that's going back. So they increasing that to $40,000 for the next 2 or 3 years, end of 2029, sorry. So the next 4 years, starting 25, 6, 7, 8, 9. That cap is increasing from $10,000 to $40,000 for taxpayers making between up to $500,000 only. If you make more than $500,000, that $40,000 start phasing out until you reach $600,000. Once you reach $600,000, the entire excess, the $30,000 increase from 10 to 40 is disappearing, and you're back at $40,000. You're back at $10,000.
Love it. And the great thing about podcasts is that if you're viewing or listening to this, you have the opportunity to keep this forever and play it back. So you also have a transcript. So please continue.
Fantastic. I get so excited when I talk about this kind of stuff. I'm not to start talking, and especially when I'm talking to my wife and she's around, says, Emil, you got to take it easy. People are not as excited as you are when it comes to this matter. But anyways, if there are any questions, you can just shoot on me. So the state and local tax is very important if you're 500,000 and under. Now, this makes tax planning even more important because let's say you're at $650,000 or $700,000 income. Means you lost the entire $30,000 increase in your SALT deduction, right? Because you're above 600,000. That's why tax planning becomes so important. Imagine you haven't implemented, you're at 700,000 income, but you have not implemented your PTE tax deduction. Remember the $3 million client that lost $400,000 of tax in their pocket? That was over $1 million in deduction over 4 years. So it's about $300,000 in deduction per year. If that client is at $700,000, that's not realistic now, but I'm just giving you an example. If they're at $700,000 and they implement the PTE and take $200,000 in PTE deduction, now they're down. Their taxable income is down to $500,000. Not only that, they save $200,000 taxes on the PTE deduction, but now they also qualify for the SALT deduction because they're under the threshold. So it's like a snowball effect. You do one thing and then it just start running around. And that's why it's very important. I push more on it. Like you gotta plan for it because you're losing out a lot by not planning, not necessarily from just the planning strategy that implementing itself that we talked about, the PTE, but that gives you many other deductions and credits if done correctly. Yeah.
No, okay. So when we talk about planning and we talk about one thing to consider is the allocation of income because there are regional law firms, national law firms. I know you've probably seen Morgan & Morgan, who they say that they're the largest personal injury firm on the planet. They have offices everywhere. So when we're talking about a law firm that may have more than one office and allocating income, if they have been planning and part of their plan is to have their principal office in a state that does not have corporate tax, say Wyoming, and they have offices in states like Tennessee that does not have income tax. Let's talk about some tax strategies for those principals and the way that income is allocated if they have multiple offices, because if the goal is to reduce your corporate tax and your personal income tax as the principal of that company, what are some of the things that law firm should consider?
Yeah. before you start thinking about the allocation, we got to look at what kind of entity are you running your law firm. I think that was one of your questions initially when we started this conversation. Depending on what structure you have your law firm in, your tax situation will be significantly different. You could be an S corporation, you could be an LLP, limited liability partnership, which not all states are recognizing. California does recognize limited liability partnership. It could be a partnership, regular partnership. Some states allow law firms to run their firm as an LLC, limited liability company. California does not, but certain states does allow that, or a C corporation. So the partnership, LLP, and LLC, those are all taxed the same way, just legally structured in a different way, but taxed the same way. S corporation is another way of taxation, and the C corporation is the other way. So we have technically three ways of getting taxed: C corp, S corp, and partnership, which includes LLCs and LLPs. LLC, LLP, and partnerships, including S corporations, are all flow-through entities, which means the entity itself is not paying taxes, other than state filing fees and state franchise fees, but there's no income tax on the entity level. We file a return, whatever income or losses there are flows through to the individual owners, as many as they are, and they pay tax individually. The C corporation, on the other hand, is different. The C corporation pays its own taxes in the entity level. Federal, 21% flat. Depending what state you are, each state has its own rates. California is 8.84%, which is one of the highest one in the country. Just to take California as an example, you're talking about roughly 30% at corporate tax. But that money you pay 30, you made 100,000, you pay $30,000 in taxes, you have $70,000 left. But that's not your money as the owner of the part of the firm. That's the firm's money. Now you decide to take that money out in form of dividends, you pay additional dividends tax on it. Okay. So the taxation, now the reason I'm talking about this is depending on where your the firm's revenue is generated from, that's where you have to pay taxes. So they don't care. IRS does not care where your headquarters is. We have clients that have physical presence in 5 or 6 different states, and they say that my headquarters in Texas, for example, there's no taxes in Texas. It doesn't really matter where your headquarters is. What matters is where the income is generated. Where are your clients? Where are you going to court? Where are your employees that generated that income? Like Morgan & Morgan, that employees across the country. They have offices across the country. They have clients across the country. They go to courts across the country. So they have to allocate. Their tax return is very complicated, by the way. It's not that I'm doing it, but I can imagine they imagine the complexity of it. So they have to allocate their income, their profit, throughout each state they're operating and where, based on where their income is generated. On the C Corp level, let's go back. On the partnership and S Corp level, since you are paying taxes on it individual level, it flows through to you individually. Means that you individually, you might be a New York resident or California resident. They have not done any kind of business in any of the other states, but your firm has. You will be forced to file income tax return in all of those states because it's a flow-through entity: LLP, S corporation, C corp, S corporation, partnership. On the C corp level, you individually do not need to do that. You only pay tax from the state you earned income, because the company itself will pay its taxes in the different states, because the company is a taxpayer, not the individuals in this case. The individual partners just get a dividends from the company and pay taxes in the state they're located in, where they personally generated the income. So the reason I drag on this answer here is because depending on what kind of entity you are, where you're based off of, and planning for this is very difficult to avoid taxation, because there are very strict rules on how you need to allocate your income. And it's basically based off where it's generated. Where did you generate this revenue? And if it's this certain state, then we got to allocate to that state. We have some clients that move out of the states, high income, high state tax states, such as California or New York. There are a bunch of clients that moved from California to Texas, Florida, Nevada, because of that reason, because California state taxes are so high. Now, you can't just claim that I'm moving to Nevada. I moved there. I lived in Nevada. It's very easy for the state to catch that. And in an audit, first thing they do, they look at your phone bill. Where are your phone? They could subpoena the phone companies, that is cell phone companies, and see where your phone calls are going out from. So if you're 95% of your calls in California, it's going to be hard to justify that you moved to Nevada. If you have kids, where are your kids going to school? Where is your driver license registered? If you're going to church or any kind of other, where are you registered? Which church do you go to? Those are all things that they look at when they establish your residency. It used to be a lot easier to cheat on this years ago. People were just saying, I moved to Nevada, Texas, I'm not paying any California taxes. The hell with this. But you can't do that, unfortunately, now, unless you actually move to that state, which many of my clients actually did because of the high state taxes. That said, Scherrie, I know I'm dragging on this. Just because you move to Texas doesn't mean that you're not paying California taxes. If the income is generated in California, you might live in Texas, but your clients are in California and you have employees in California, which means you still have to pay California source income on this income. So it's very important to do proper planning and be careful with these things, because it could come back and bite us in the end.
And so a lot of attorneys now also have forms or digital products or digital assets on their websites. Would the same apply in terms of allocation? Because if I am a Mississippi-based attorney and someone in New York purchased a form from my website, how is that income allocated?
Yeah. Each state has different rules for that. And the regular basic rule is if you do more than a certain transaction in that state, you got to report that income in that state. It's not only lawyers. Let's say you sell items like Amazon sellers, like people selling items on Amazon. Let's make that as an example. We don't have those kind of clients, but if you sell a certain amount of, if you have certain clients in that state, could be 50, it could be 200 clients, depending on the state. I think New York has, 200 transactions in that state. If you have that, then you have to allocate that income to that state because you sold something to people in that state. But if it's less than the threshold, then that state allows you to just report everything in your own state where you're located. Same applies to lawyers selling forums or selling something else than just legal services. Right? You have more than a certain amount of transactions for that specific state, which again, each state have its own regulation how you establish nexus. That's what the rule is. And you got to be careful with which state you're selling to and what that state's regulations are. You might need to allocate income to that state also. But if it's under the threshold, you can just allocate it to your own state.
So the through line that I'm getting from this is that your CPA is your friend. Is that pretty much it?
CPA is your partner. That's how we see our clients. I see my clients as a strategic partnership. We work together. I'm not taking any part of their profits or losses, absolutely not. But in terms, it's a strategic partnership between us, and you want that. Whether you become friends or not, that's another, just a bonus on that. But you definitely want to have a very strategic relationship with your CPA to be able to take advantage of all of this.
Now, this has been so good. And additional news for those who are listening or watching this video is that you have recently published a book that can actually help us. And we can put this next to on our coffee table or next to our bed on our nightstand and catch some of this. Tell me a little bit about the information in that book and how it can further inform on this conversation.
Yes, I appreciate it, Scherrie, for bringing it up. So the title of the book is Counsel to Counsel. And it's basically Counsel is us, me, my firm. Our firm name is Council CPAs, by the way. So we offer counsel to lawyers that are counsel. But same way, lawyers are counsel to their clients. So it's Counsel to Counsel. That's where the title comes from. And it's a very practical book. It's not a lot of tax code or theories in there. It's more practical based on my experience of running a CPA firm for the past 17, 18 years. And with what I have seen with my clients, how they run their firm, success stories and less success stories of my clients, mistakes I've done, mistakes my clients have done. I've tried to share all my experience by running a business rather than running a practice. If I can help just few law firms accelerate that process and do it much faster than I did, because it took me forever to come to this conclusion of where I am right now, to run my business as a business, not just as a practice. And because I didn't know any better, to be frank. I made millions of mistakes, probably cost me a lot of money with a lot of mistakes, but that's the idea with the book, to share my experience, share my clients' experiences with the readers, to help them grow a business. And it's very, once you get to that point, when you convert the practice to a business, it's a very eye-opening and it's refreshing. The reason is, when we first start off our practice, we're super excited. We print business cards. We create a website. We're excited. We go to networking. But it doesn't take much or long until we realize, God damn it, what's happening? Doing all of this work, all the legal work, all the marketing, networking, accounting, administration, billing, you name it, IT. I do all of this that I was back then at the firm where I work. I was only doing the legal work. Now I'm doing all of these, and I'm even making less than what I was making at the firm. Something is wrong. But once you get the idea, when the kind of it clicks how to run this as a business rather than a practice, it becomes so, I can't find the word for it, but it's so refreshing and feels nice to do it. So that's what I'm trying to do with this book, and help lawyers hopefully be able to convert the practice to a business, to have a better life.
Now, you got to tell us where to find the book.
It's all over the place, actually. Amazon absolutely is there. We have on Barnes & Noble, or all online platforms where they sell books. It's on our website also, councilcpas.com. You can find it there. But Amazon have it, and it's all there.
So you've shared so many great tips for us. But if you had just one piece of advice that can jumpstart an entrepreneur's law practice, someone who is maybe starting on their own with their own shingle, what would that be?
I want to share two things. I didn't do either of them when I first started. One being, if you have the opportunity. I did not have the opportunity, neither did I have the knowledge to do it back then, but I wish I did it back then, that I specialized from the beginning. Be as specialized as possible, because it will help you, your firm. It's going to be a lot more scalable. It's going to help your team. It's going to be a lot more organized for your team. But also, more importantly, it's going to be a lot more to your client's benefit, because you're so much specialized and know their issues that you can provide a lot more value to them. It's a win and win from whichever angle you look at, if you're specializing. In my case, I wish I started working with lawyers from day one. I didn't. I learned my lesson in the hard way, but that's number one. Number two, that you can actually do, even though if you don't have the opportunity, or if you cannot find the specialty, run your firm as a business and not as a practice. You got into this to run a business. Otherwise, you will probably have stayed at the firm you were. If you just want to have a job, you can as well stay where you are. Just because you form your firm doesn't mean that you got to work less. And whoever tells you have flexibility, that's bullshit. Sorry, excuse my French. You got to work your ass off until it's up and running. So you might as well do it in the right way and build a business. And with that, what I mean is, doesn't mean that you step away, you're not involved in the operation, you hire lawyers and they do the work. No, you put systems in place from the beginning. You delegate with systems and control, where you can monitor the work, you monitor the quality of the work, and at the end of the day, you are signing off everything going out of the firm. But have the right systems in place, put the processes in place from the beginning when you have the time, because it's a lot harder to start changing your operation after years of doing something in the same way. Start off with running a business instead of a practice.
Emil, thank you so much for joining us.
My pleasure. Thank you, Scherrie, for having me. It was really nice to talk to you.
And if you are viewing this or listening anywhere that you get podcasts and you have enjoyed this conversation as much as we have, follow the podcast or subscribe on YouTube and drop us a comment to let us know what you enjoyed the most. And until next time, play big faster.
Thanks for listening to this episode of the Play Big Faster podcast. Want more entrepreneurial content?
I like this.
Make sure to subscribe for future episodes.
Already subscribed. I just clicked on it.
Don't forget to like and leave a review. Share with a friend that needs this in their life.
I think you need this more than I.
Oh, and make sure to follow Scherrie on IG at Scherrie Speaks. And remember to play big faster.